Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about first, heading into today's open, a tech bloodbath is brewing as a $10 billion AI deal implodes overnight, triggering alarm bells with futures wavering. Watch for whether the Magnificent Seven can defend their ground at the bell or if a capital exodus triggers market chaos. Second, Tesla's $2.9 billion deal evaporates. Shocking contract collapse triggers EV supply chain crisis. This isn't just about Tesla, it's a critical warning shot for the entire sector. Will this trigger a commodities crash for lithium and nickel at the open? And is the entire high-growth tech narrative about to be repriced? Finally, the student loan bankruptcy myth is shattered. A little-known rule change creates a historic 87% success rate. This changes a fundamental rule of personal finance, but the real story is for investors. As this safety valve opens for consumers, will it trigger a quiet crisis in the $1.6 trillion student loan securities market? Red alert! Beneath the calm surface of a 17% annual gain, a massive rotation is tearing through Wall Street. The year-end victory lap has been cancelled for the technology giants, and capital is aggressively fleeing the very winners that defined 2025. While the S&P 500 hovers near 6,915 points, barely holding its ground, the real story is the fracture underneath. The Nasdaq 100 is slipping down 0.3% yesterday, continuing a sharp December reversal. The broad index numbers are masking a violent shift from growth at any price to safety at a reasonable price. The divergence is stark. While the headline index is flat, the internal mechanics show a market that is deeply skeptical about the next leg of the rally. The core question dominating trading desks today is simple. Why is the market punishing its winners right at the finish line? The answer lies in a collision between sticky inflation, a hawkish Federal Reserve reality check, and emerging doubts about artificial intelligence profitability. From a policy perspective, the narrative has shifted dramatically. Although the Federal Reserve cut rates to a range of 3.5 to 3.75% earlier this month, the market is waking up to a higher for longer reality. Inflation is holding at 2.7%, well above the target, driven by a recent 3% surge in gasoline prices. The Fed's latest dot plot signals only one rate cut for 2026, shattering the aggressive easing narrative investors priced in last summer. This matters because the 10-year Treasury yield has climbed back to 4.12%. When the risk-free rate rises, the present value of future cash flows for high-growth tech stocks compresses mechanically. However, the pressure isn't just macro, it is structural. We are witnessing the great rebalancing. After a year where equities outperformed bonds by a massive margin, pension funds and institutional managers are forced to sell stocks and buy fixed income to return to their target allocations. Analysts estimate this is triggering $43 billion in selling pressure, specifically targeting the Magnificent Seven. This is a non-discretionary mechanical outflow that is capping upside momentum regardless of company fundamentals. Valuation concerns are exacerbating this flow. The Schiller P/E ratio currently stands at 40.59, a level seen only twice before in history, 1929 and 1999. At these altitudes, the market demands perfection, yet we are seeing cracks in the AI narrative. The epicenter of this shakeout is the AI infrastructure complex. Nvidia declined 1.2% yesterday, and Broadcom is under pressure following warnings about gross margin compression due to the high costs of scaling AI production. But the most alarming signal for the sector came from Oracle. The collapse of financing for their $10 billion Michigan data center project has sent a shockwave through the industry. Analysts are interpreting this as a sign of capex fatigue, a warning that the appetite for funding massive AI infrastructure projects is hitting a ceiling. When capital providers bulk at funding data centers, the entire growth thesis for the semiconductor supply chain faces a stress test. Even Tesla is caught in the downdraft, falling over 3% yesterday. The market is repricing the EV giant from a high-growth tech multiple to a cyclical automotive valuation as competition intensifies and margins compress. Conversely, capital is rotating into sectors that benefit from the current geopolitical and economic reality. Energy stocks like ExxonMobil and Chevron are defying the trend, rising largely due to geopolitical tensions involving Venezuela and Ukraine, keeping oil prices supported near $58 Financials are also seeing relative strength. In a world where the Fed keeps rates above 3.5% through 2026, net interest margins for major banks remain healthy. This rotation confirms that smart money is moving toward cash-generating, value-oriented sectors that can withstand a high inflation environment. The market has moved past the euphoria of 2025 and entered a phase of intense scrutiny. The next 2 weeks will determine if this is merely a mechanical rebalancing or a fundamental regime change. All eyes now turn to the upcoming fourth quarter earnings season kicking off in January. The critical metric to watch is not just revenue, but the capital expenditure guidance from hyperscalers. If spending slows, the AI valuation premium faces a significant repricing. Until then, volatility is the only certainty. Heading into today's open, a nearly $3 billion deal for Tesla has just imploded. A major supply contract, initially valued at $2.9 billion, has been shockingly slashed to just $7,386. And no, that's not a typo. South Korean battery material supplier L&F confirmed overnight that its massive deal to supply Tesla, stock ticker TSLA, has been almost entirely wiped out. The deal was for high nickel cathode materials, a key component for Tesla's next generation 4680 batteries, the same ones powering the Cybertruck. The backstory here involves the immense technical challenge these 4680 batteries represent. The company has been trying to perfect an innovative manufacturing process called dry electrode coating, but research suggests Tesla is struggling to master this technique at mass production scale. Current output is estimated to support only about 24,000 Cybertrucks annually, a fraction of its 250,000 vehicle target. This production bottleneck is a major reason why demand for materials from suppliers like L and F might be collapsing. So analysts point to a perfect storm. Tesla is reportedly struggling with these complex new batteries, just as overall EV demand growth is slowing down globally. This isn't just a feeling. You can see it in the data. A key indicator to watch is the auto inventory to sales ratio, which has been climbing, indicating that cars are starting to pile up faster than they're being sold. This build-up suggests the explosive growth in consumer demand for big-ticket items like EVs is beginning to cool off. One analyst bluntly stated there is now anxiety about the battery sector overall. This is where the situation takes a more complex turn, because it's not just a Tesla story. This news is a major warning shot for the entire EV supply chain. In recent weeks, LG Energy Solutions saw a $9.4 billion revenue expectation vanish after Ford, ticker F, terminated a battery deal. In another blow, SK On and Ford are ending their US battery joint venture. This has crucial geopolitical implications. The US government's Inflation Reduction Act was designed to build an EV supply chain outside of China, favoring partners like South Korea. But as US automakers cancel orders, these Korean giants may be forced to look for more reliable customers in Europe, or even deepen ties with Chinese partners, potentially undermining the very goal of creating a US-centric ecosystem. This all comes as Ford itself announced a dramatic retreat, taking a $19.5 billion write-down and scrapping several EV models. A write-down, by the way, is simply an accounting move where a company admits an asset, in this case, its EV factories and technology is worth far less than previously stated. Ford's move signals what some analysts are calling a capex whiplash. After a period of massive investment driven by hype, the company is now slamming the brakes. At the open, watch for how this sentiment could create downward pressure, not just on automakers, but also on industrial commodities like lithium and nickel. This cascade of cancellations paints a picture of a sector under immense pressure as a story of hypergrowth suddenly shifts to one of massive cutbacks. What we're witnessing is the hype to reality gap in real time, and the key question is whether this tech disillusionment spreads beyond the EV sector, posing a valuation risk to other high-growth stocks priced for perfection. While the tech sector grapples with that hype to reality gap, a completely different kind of repricing is happening in the world of personal finance, and it could quietly reshape the entire consumer credit market. A new study reveals the success rate for discharging student loans in bankruptcy has skyrocketed to 87%. That figure is a massive jump from just 40% in 2007, following updated guidelines from the Departments of Education and Justice that simplify proving financial hardship. This development impacts over 42 million Americans holding a combined $1.6 trillion in student loan debt. Now get this. This isn't just about individual household budgets. Much of this debt is packaged into financial products called student loan asset-backed securities, or SLABs. This administrative change will force a repricing of risk in the SLABs market, especially for securities backed by private loans. So at the open, watch for unusual activity in funds with heavy exposure to this specific type of debt. What's truly astonishing, though, is the information gap the report reveals. Out of more than 3 million student loan borrowers who filed for bankruptcy over the last decade, only about 7,000 even tried to have their student debt cleared. Our legal expert says this belief is so pervasive that many attorneys never even raise the possibility. From a market perspective, the key is a specific legal step called an adversary proceeding, essentially a lawsuit within the bankruptcy case. The number of these filings is a critical leading indicator of borrower awareness. While historically low, recent data shows a notable uptick since the new guidelines were introduced. A sudden acceleration would signal this information gap is closing fast, potentially triggering a wave of consumer balance sheet repair. This news also comes just as the government has confirmed it will begin garnishing the wages of borrowers in default starting in early January. You know, this tension introduces a new dynamic that economists are calling a potential safety valve for consumer credit. If a struggling borrower can discharge a massive student loan, they suddenly have more cash for credit card and auto loan bills. This new bankruptcy path could therefore suppress delinquency rates on other types of credit, making the American consumer appear healthier than they actually are. For millions, this newly streamlined process is being called the only real path out, a development that could send ripple effects through credit markets. When we place the US household debt at around 69% of its economy, alongside China's at about 60%, the stakes of this American policy experiment become even clearer, and it could inform how other nations manage their own household debt challenges in the future.
That's it for today on Voce Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.